Welcome to The Explainer. Today, we are digging into the latest from Truist Financial. We're going to peel back the layers on their Q4 earnings report to really get the story behind the numbers. All right, let's jump right in. So what's the headline? Well, for the fourth quarter, Truist just missed what Wall Street was hoping for. Both their earnings per share and their revenue, they came in just a little bit shy of the forecast. So you gotta ask, right? Is this just a one-off thing, a little blip on the radar, or is this maybe part of a bigger story? To get to the bottom of that, we really need to zoom out. So here's how we're going to break it all down. We'll look back at the full year, peek inside their core businesses, check out their game plan for what's next, and then we'll get to the one big number that's driving everything.
Okay, first things first. Let's get some perspective on that one quarter by looking at the report card for the whole year. So 2025, it definitely wasn't a walk in the park. The whole banking sector hit some rough patches, and Truist was right there with them. If you look closely at that fourth quarter, you'll see their bottom line took a hit from a couple of one-time things, some legal costs and severance charges. But, despite those headwinds, the CEO, Bill Rogers, he's telling a different story. He's framing 2025 less about the challenges and more about building up some serious momentum for the future. And here's the really crucial part. If you look past those headline numbers, the company was actually hitting some major goals they'd set for themselves. I mean, they grew their loans, they kept a lid on costs, their asset quality stayed strong, and get this, they returned $5.2 billion to shareholders. Okay, so let's pop the hood and look inside the engine room. We're going to check out the bank's two main divisions to see what's really driving all this and where that momentum is coming from. Basically, you can think of Truist's business as having two big parts. You've got the consumer and small business side. That's everything from your mortgage and credit cards to a loan for the local bakery. Then you've got the wholesale side. That's the heavy-duty stuff for big corporations, investment banking, treasury services, the whole nine yards. Now, on that consumer side, they saw some really fantastic growth, especially with their premier banking for wealthier clients. Lending there was up a whopping 32%, and their push into digital, huge. They added over 77,000 new clients online in just the last quarter. That's pretty impressive. And what about the wholesale division? Well, after a kind of slow start to the year, it just came roaring back in the second half. I mean, it totally flipped the script. Just look at investment banking revenue in the fourth quarter, up a massive 28% from the year before. All right, so with all that momentum heading out of 2025, it's time to look forward. Let's check out the official game plan for 2026. First up, let's talk revenue. They're projecting growth of 4 to 5%. Now, to put that in perspective, the CEO made sure to point out that this would be double the pace they saw in 2025, so a big step up. And a huge piece of that growth is going to come from their loan book. They're expecting to grow loans by another 3 to 4%, and it looks like they're really focusing on their commercial clients to lead the charge. Okay, and what about for shareholders? This is a big one. The company is planning to buy back $4 billion of its own stock. That's a 60% jump from last year. That's a pretty powerful signal of confidence for management. So when you put it all together, growing revenue faster than your costs, it all points to this one really important goal, something called positive operating leverage. Now, it sounds complicated, but it's not. Think about it like a lemonade stand. If your sales double, but the cost of your lemons and sugar only goes up a tiny bit, you're making way more profit on every cup. That's exactly what Truist is trying to do here. So you can see how this all fits together, right? These goals for 2026, they aren't just random numbers. They're all building blocks. They're all steps toward one big long-term target. So what is that ultimate goal? What's the one number that the CEO keeps saying they are absolutely locked in on? Well, it all comes down to this metric called ROTC, Return on Tangible Common Equity. Yeah, it's a mouthful. Don't worry about it. All you need to know is that it's basically a report card for how well the bank uses shareholder money to make a profit. Simple as that. The higher the number, the better they're doing. And that big number, their ultimate target, their North Star, is 15%. The goal is to hit a 15% ROTCE for the full year 2027. And look, this isn't just some number they pulled out of a hat. In the banking world, hitting 15% ROTCE is like the gold standard. It signals you're a top-tier, high-performing bank. And they are not being quiet about it either. The leadership team is broadcasting their confidence that they can get there. Everything they're doing right now, every bit of loan growth, every dollar of cost savings, it's all designed to get them to that 15% finish line. So when you pull it all together, what's the story? It's about a kind of meh quarter, sure, but that's hiding a full year of real strategic wins and a super clear numbers-focused plan for the future. So the big question we're all left with is this. They've got the momentum, they've got the plan, but can they actually pull it off and hit that ambitious 15% target? That's what we'll all be watching.